Good afternoon. This is Bakes, Kevin Baker with Bakes Takes. Welcome to my podcast. It is Saturday, March 27th. Let's get right into it, folks. Number one, growth, value. I don't care. You shouldn't either. Number two, shorts at a record low. Surprising chart coming up. Number three, ARKK, taking on water. See what I did there, Mike? I'm easily amused. I can't help myself. Why I do this, Bobby and Jack, my sons, they've been on the pod. They're in their 20s. They came out of undergraduate business programs, and they'd fire questions at me. And their friends would join in about money, markets, job interviews, etc. What's going on with the 10-year bond? Why do I like stocks? What groups am I interested in? I went through the 87 crash, got my head handed to me, and learned that I didn't know what I was doing. Wall Street analysts didn't know what they were doing. And I just read everything, and I've discovered technical analysis, reading charts, and I go technical analysis first, fundamental second. It just works for me. It's not right or wrong. You decide what works for you. I read the Journal, Barron's, the Economist, newsletters. I listen to podcasts. I monitor what my Google alerts are kicking out, and I bring them to you, point you to them, and always give attribution, but know that if you don't want to do all that work, I'm doing it for you, and I'm hopefully distilling the complex down into the simple. I eat home cooking. I show you what I invest in. I talk about what I'm interested in. I don't have conflicts. But tell me, what are your pain points? How can I be helpful? What can I add to the show? Problems you'd like me to help solve, topics I should cover. Your feedback is invaluable. It guides us, and I really appreciate it very much. Now, my disclosure. This is an investment advice. Please conduct and share your own due diligence, and I'd really appreciate that as well. Fan mail, Murph came in, gave me a text, shared with Jack, my son, and asked about John Deere. Cramer was talking about it, Jim Cramer on CNBC, talking about scarcity in the farm equipment space, and it brought up the first point that I highlighted. Deere's acting like a growth stock, and here's the daily chart that you can see. And I just, I take this opportunity to make some points. As an individual investor, and that's who almost all of you are, you don't growth value these labels. You don't care. I don't care. You shouldn't care. It's the institutions use this so they can put people in boxes, and they can say, high-minded things like we're reallocating from large cap growth into small cap value. Okay, that's wonderful. It doesn't matter to you. It's certainly not to me. Frankly, I don't think that works very well, but that's just, my view. I just want to make money this year. That's my focus. Make money this year, and B, don't lose money this year, and C, remember A and B. I keep it very, very simple. Most institutional managers, they hug an index to some extent. That's a dirty little secret, but that's the way you get paid. You beat the index by a little, so you make, modest selections, overweight or underweight the index, and you get paid if you beat the index, the Russell 2000 or the S&P 500. So I want to throw all that out the window. Now, having said all that, okay, this looks like a growth stock. And by the way, it is a growth stock. The earnings were down last year, understandably. Almost everything was except for technology. And if the analysts are right, the earnings per share are going to grow 84% this year. It's a big eye-popping number. Now, last year stunk. So, you take it with a grain of salt. Next year, earnings are supposed to grow 16%. And frankly, the Deere CFO doesn't know what they're going to earn next year. So take that with several grains of sand. And oh, by the way, another point is, and this is why I like charts so much, the news was dreadful back in July. Look at this. I didn't put the arrow on this. I forgot to. I apologize. But back in June, July last year is when this started taking off. And it looked like the world was coming to an end. And so in the midst of all that misery, off it goes. And what did this do? stocks are discounting mechanisms. It sniffed out, the Deere stock in this case, sniffed out that we weren't all going to die of COVID. We were going to reopen. People were going to be pretty damn hungry, and they were going to have to grow more crops. How's that for a pretty simple summation? And I think that's about as complicated as this has to be sometimes. We don't have to, make ourselves crazy by overcomplicating things. Now, it feeds into the some of the themes that we've talked about. China coming out of COVID faster, their swine herd, and I know every podcaster talks about swine herds, but I have to add my 2 cents. They were decimated by disease back in 2018-19, I think, and the Chinese are hungry, and the hogs are hungry, and they're feeding them corn and soybeans as far as the eye can see. Pretty simple stuff. So I like this idea. The stock trades at 20 times next year's earnings. That's usually what you do. You look out a year, you see what the PE multiple is, and you say, okay, one subtlety that I didn't mention on the chart is if one of the things I've always liked to do is have the valuation relative to its own history. Is 20 times at the high end or the low end, and I didn't do that in this case. I forgot to. But anyway, 20 to me, Murph, 20 times earnings for 2022 earnings sounds okay. I mean, it's obviously a pretty chart. There's no denying that. You mentioned the scarcity issue. Agco, AG, is really the only other big liquid U.S. stock where you can, play, if you will, or participate in farm equipment growth. So you do have this dynamic where if a portfolio manager says, I really need to be in farm equipment, you're kind of pulling Deere off the shelf every single time. For the cyclical play or the value play or economically sensitive reopening play, they pull the Caterpillar off the shelf too. So that's what's playing into this. Here's the monthly. And, it's going vertical. I mean, it looks like a growth stock. And but this is how cyclicals often work. You have to buy them when there's blood on the streets, and you have to kind of fade them when they look like this. Now, I'm not there yet. So, I mean, it's a good-looking chart. It could go north. Here's my take then. Don't be an institution. Growth versus value is irrelevant for how you invest, in my opinion. I don't care. You shouldn't care. If you focus on how to make money this year, it's a great lens through which to view all these news items that we come up with. Broke out at 170 back in July of last year. Now it's at 372. That's 200 points. That's a double. That's a good way to make a living. For whatever reason, I didn't find an ETF at that point that grabbed me. I don't know why, but it's okay to miss things. There's plenty to do. Deere looks extended to me, and I'm curious, and I encourage you to monitor how it responds to good news, especially if it blows out earnings. If it blows out earnings, both the top line and the bottom line, and the stock yawns, then you got a problem. Then everybody that's invested in here pretty much has a full position, and they're going to be looking for the next item. I hope that's helpful. I hope I was on point. Tell me if I'm not, okay? And please, everybody, please share this with your Robinhood friends, your Reddit friends. Send other stocks ideas. I eat this stuff up. I love it. I love offering strategy. I've been doing this a long time, and particularly on the sell side. I'll try to keep you out of harm's way as best I can, so please stay tuned. Next are my themes and groups, and you'll see this when you go through my social media, all my hashtags. GameStop, talk about that briefly. We own the retail ETF that we just bought recently. GameStop is 4% of the index, and I did that just for my amusement as much as anything else. Can I see the whole thing, buddy? Sorry. Thank you. I think retail is going to be great overall because a lot of people got $1,400 checks, And I, for one, can't wait to have a bonfire full of mass in my backyard. And everybody I'm talking to is just dying to go out to eat, fly to Florida, and go someplace and do things and spend money. And I think it's going to be unleashed over the next 9 months. It's going to be astonishing to see, in my opinion. Uranium, we'll talk about uranium more. I'm about as subtle as a 2x4 with this. I like uranium a lot, and I think every time I turn the page, the story gets better. Cannabis, I'm getting more bullish on cannabis every time, too. We'll talk about that more. Bitcoin is yes, there was some red on the screen this week. I get it. Yellen says some things. Bitcoin is, again, we've talked about the math. I think it goes to somewhere around 380 to 480 over the span of, picking 5 years. I don't know. But we're at 55 right now, give or take. So there's a lot of upside. Blockchain, the more I learn about NFTs and blockchain, the more enthusiastic I become. Copper is clearly ripping and working and will continue to do so. The softs, so to speak, agriculture, sugar, soybeans, wheat, corn, we own that through the ETF tags, and that is clearly where that's actually the laggard in the portfolio. And I mentioned that I do not like bonds. I'm not going to use the word hate because my mom doesn't like that, but I'm short bonds, and I'm going to be short bonds for a long time. I don't care what Powell says. Inflation is here, and bonds are going down. I just believe that. Now, I draw your eyes to the portfolio, and as usual, the far right column, and this is what I do every day. And I probably shouldn't be as short term, but that's what I do. I can't help myself. You'll notice that there's one tiny sliver of red. The agricultural fund hasn't really done much. I don't have any big losers. I don't have anything down 15% or more that's taken up my time, my attention, my money. So I have everything is working pretty hard to make money while I sleep. So that's, and I'm holding my feet to the fire. I'm up 14% year to date. The S&P is up around 6%. I'll take it. It's not bad. It's not bad at all. I hope you agree with me. All right. My take, this is a very unconventional portfolio, and you're welcome. It's working. Our themes are intact, and month end is coming up, so I'm going to lock myself in a room and go through all the charts with fresh eyes, I hope, and find new themes to bring to you, to exploit. And if you have ideas for me, bring it on. I love it. I love it. I love it. Next, podcasts of the week. And I think I've been including this on almost every show since I found it. But it's great content, and I think it's useful, and I think it's impactful and makes us money. Guy Adami, Dan Nathan, Danny Moses on the Tape podcast. And around 20 minutes, they bring up Cathie Wood. And a pretty galvanizing figure. She's the CEO of ARKK, and she crushed it last year. I mean, she got several funds, but I think the flagship was up 152%, something like that. Very bright woman, visionary. But here's the point that they made, and I'm making to you, is over the weekend she came up with work that her analysts put together, suggesting a $3,000 target for Tesla from $600 right now, give or take. And the stock didn't care. And normally, if Cathie Wood said Tesla was worth $3,000, you'd have a lot of people trying to get it there in an afternoon. And the fact that it yawned, it's noteworthy at a minimum. And I encourage you, like the podcast folks, watch if it broadens out. This is kind of what happened in 2000, where Cisco blew out earnings, no one cared. Microsoft, Intel, Lucent, I'm dating myself, and it's just, we're not there yet. But I want you to pay attention to that. And I know a lot of you own Tesla, and you're fans of the car, and you're fans of Elon, and you're a fan of the stock. So I just want you to keep an eye on this. And this is very typical. I'm now showing the daily chart. this is kind of what the ARK stocks look like. They had huge moves. They're pulling back on pretty heavy volume to moving averages. So they broke the 50-day. That's a little bit of a concern. Nothing cataclysmic, but the 200-day moving average is at 500. We're at 618 right now. The volume is picking up on the down days pretty significantly. You know I don't like that. And keep an eye on this. Keep an eye on this. Next thing they talk about is cannabis. And this is kind of becoming Uranium 2, the sequel for me. Recreational use was just approved in New York. And why it takes a year to implement, I don't understand. Why that isn't a light switch, I don't know. But politicians are involved, and I might have just answered my own question. At 55 minutes, Brady Cobb came on. He's the CEO of Bluma Wellness. Their company is focusing on very high-end, high-quality cannabis, and they're going to brand and price it accordingly. So this is becoming CPG, consumer packaged goods. But he talked about going into Mitch McConnell's office, Senator McConnell's office, lobbying, suiting up, as he says, and starting off the meeting by raising his hand and say, Senator, please, we would like you, the government, to tax us and regulate us. And no other lobbyist is coming in to say that. And it just feeds into the rationale for investing in YOLO, which is this chart right here. States need money. The political winds have shifted clearly. The lobbyists in the cannabis world are getting better. Now they're going up against the pharmaceutical companies and the alcohol companies, and they're no slouches. But to see what's going on in terms of the tax revenues alone is noteworthy, and I think these dominoes continue to fall, and I think cannabis stocks can work for a long time. In particular, a lot of these companies are free cash flow positive with really onerous banking relationships, paying higher interest rates than the real world would suggest. So if they can ever get this off their back and have a better regulatory framework, then they're going to be making even more money. So my take is the sell discipline for Tesla has not kicked in, but be wary. If you see this close below the 200-day moving average at around 500, I would start getting sell tickets out. If it closes below there, I would sell a third. Period. End of discussion. I've talked about that before. Cannabis, the bull case keeps building, and I really like the podcast. I recommend it highly. I hope it adds value to you. Next, the Pomp Podcast. Anthony Pompiano, but everybody calls him Pomp. Scott like bakes. And Jim Cramer was on, and I didn't realize this because I haven't heard him say this on CNBC. He's become a believer in Bitcoin to the extent that he had extensive conversations with Pomp before this podcast, and he put $500,000 into it. He did what I did. I didn't put that much into it. But when it had that huge move in a couple of months last year, he took out half his investment, and he's letting the profits ride. And he's a pretty visible guy, and to have him as bullish on Bitcoin as he has now become is pretty noteworthy in my view. Who else is becoming bullish on Bitcoin? A lot of corporate treasurers. It's not going to be MicroStrategy and Tesla alone for very long. All major companies either have or are forming a Bitcoin strategy, and that's billions of dollars waiting to buy the asset over the ensuing 5 years. So it's not going to happen next Thursday, but the demand for Bitcoin is real. It's becoming more accepted, and I think you have to own some. You pick out the percentage and the vehicle, but I own GBTC. I think that it's got a long ways to go. Next is Reporters of the Week. This is The Economist. They don't use bylines, which drives me crazy because I think their work is so good. But no one asked me from London. This is the $3 trillion question. And the first paragraph kind of says it all to me. Back in World War II, the U.S. government put restrictions on economic activity that dwarfs what we see going on, or have seen what's going on with shutting down restaurants and football stadiums for COVID. They ration everything from coffee to shoes. They banned manufacture of fridges and bicycles. Sounds kind of silly right now, but that's what it was, all hands on deck for the war effort. In 1943, the auto industry sold, I had to check this out, 139 cars. That's not a typo. That's not me mispronouncing it. Only 139 cars were made that's in the middle of the war. Fast forward to 2 years later, and consumer demand just started to rip. You had the Greatest Generation return and take advantage of the GI Bill. By 1950, car makers were making 8 million vehicles a year. That's crazy. Reason I bring it up, something similar is going to happen this time around. What did we do? We fought COVID. And I'm not going to make it as dramatic as the war, World War II, although I believe more people died in COVID than World War II, horribly. But savings went up. The government sent checks. People that had jobs couldn't spend as much money on trips and going out and what have you. And that's all coming to an end right around now. So I'm very bullish on the economy, and then I'll go do my work to find the stocks that fit into, or benefit from that. And that's always going to be my prism. So next is the Wall Street Journal. This is Jinju Lee, and I bring this up. This is the spot uranium price. The headline is uranium has that healthy glow again. And then here's the spot price. And it's just great perspective. We've come off the bottom. You call it 1820. We're now at 29-ish. We were in triple digits at the beginning of this chart. Only 12 years ago, we were 80 plus. So it's just a good visual representation of how much we can retrace to have uranium prices become the revenue lines of our companies in URNM, and then turning into earnings and much higher multiples, in my opinion. The World Nuclear Association estimates roughly 50 new reactors are being constructed in 16 countries, most notably China and the United Arab Emirates. That's compared to 440 right now. So it's a big percentage. Yes, they can be delayed. Yes, they can be postponed. Yes, there can be cost overruns, but the demand for nuclear energy is on the rise. And I think if you pulled people off the street, 1 in 100 would be aware of that cold hard fact. A realistic reason for optimism, he writes, is in the steady cutback of uranium mining in recent years following years of oversupply, which we've talked about a lot. Compared with 2016, the world mined 12.2% less uranium in 2019. That's a big number. So my take is this is not the greatest generation coming back from World War II, but an economic surge is very, very likely. And this could be good for stocks if bonds don't spoil the party. And we've talked about that, and I'll address it more if you'd like me to. Next, this is the first time uranium has been mentioned in the B section of the Wall Street Journal in my memory, and I've been looking for this. It was above the fold. So this is gaining more and more attention from more and more people, and the hedge funds aren't even really here, in my view. And when they do, you're going to see prices go up a lot. URNM, our ETF that we own, is up 88%, and spot's hardly done anything. It's still under 30, and could it go back to 80 plus? Sure sounds like it from what I just described. It's just going to take time, but this is our modus operandi. Find big themes, latch onto them, let them ride. And uranium, I'm a fan. Next, charts and tweets of the week. And I can't help myself. Yes, I go to the Wall Street Bets and see the insanity that goes on there. And, of course, they were saying, okay, we've killed the short sellers. I'm paraphrasing, but that's sort of what they're championing here. This is a Goldman Sachs chart. This is the S&P short interest, the median S&P 500 short interest as a percentage of market cap, and it's down to 2,000-year lows. Now, what does that mean? Counterintuitively, it's bearish, or at least should create some caution. The fact that the shorts have been squeezed so badly that they've come to these levels is a sign that we're near highs, near tops. I hate to say it, but it doesn't have to be that, and it's hard to precise the time, but those are the numbers and those are the dates. And then you look at the S&P next, and they don't match up. I couldn't scale them exactly, but you look at the far left. Here we are at 2,000. When we hit that short interest ratio, look what happened. We had a pretty meaningful decline. The bubble burst, basically. And so here we are today, hitting new highs, wedging up on unimpressive volume, and short interest is at 1.5%. Again, it isn't cataclysmic at this point, but this is where we are right now, and I want you to be aware of the relative extent to where we are in terms of the frothiness in the market. Next, newsletters of the week. Bear Traps Report, Larry McDonald and his team really like these guys. And they brought up the ARK Innovation ETF holding, ARKK, that's Cathie Wood's flagship fund. And this has, a lot of really high flyers, Zoom and Taiwan Semi and Roku and Tesla, of course. And just looking at the holdings, they're all but two are below the 50-day moving average, which is just a warning sign, but it's a sign of technical damage at a minimum. And they're all oversold. Now, how they define it, that's in the eye of the beholder. But the Tesla chart that we showed before is a very good example. And this is what I bring up. Over 50% of ARK's inflows happen in the last 4 months at an average price of $131. So you've got $11 billion in capital with an average price 13% above the current price. So I caution you that if you own some of the individual names in ARK, which has become a spectator sport, following Cathie, that if you start to see redemptions and her selling these stocks, they're going to go south much faster than they went north. So look at the list, check your portfolio, and adjust accordingly, in my opinion. Next, okay, I'm going to get a little wonky, but I like this stuff. S&P Weekly Relative Strength Divergence. And it's just the market's making new highs like it did back in 2000. And no, sorry, that isn't the date. This is February 2020. Stocks making new highs, relative strength not making new highs and showing a divergence, and then you see the correction. So I don't think it's going to be February 2020 with COVID and the whites of our eyes showing up, but it's another warning sign. And I do look for overtly bullish charts as well, but I'm not going to kid you when I'm finding bearish things like this that I ought to bring to your attention. So next, new highs minus new lows, and I'm a big fan of these things. If these phenomena occurred in the past and stocks declined after that, we should watch them. And that's it. But we're having new highs, new lows, starting to break support levels. And as you can see from these three lines that go back a long, long time, it's not good for stocks. So we'll keep an eye on this as well, I'm sure, Larry. And by the way, the Bear Traps report is terrific. I think you should sign up. Last hour of trading pain. The old adage used to be, the dumb money buys in the first hour, and the smart money settles up in the last hour. And that isn't entirely true. It's a little bit, oversimplified. But the bottom line is that the market is starting to fade off in the last hour. That's a sign of distribution, stronger hands selling off into weaker hands, and it's a sign that the rally's flattening out. So, again, just another argument in the cautious column. That's all. Pomp's newsletter, which is great as well. Will the Bitcoin ETF? Don't edit that out. I want to show some vulnerability here, Mike. Will the Bitcoin ETF be similar to the gold ETF? And oh, by the way, this is Fidelity talking about an ETF. I mean, this is a major financial institution. I'm not casting aspersions of the others, but Fidelity is a pretty gilt-edged name. Anyway, he brings up the gold ETF. Back in 2003 when they started, there was $200,000 in them. There's $100 billion in gold ETFs in the U.S. alone right now. There's ex-U.S. ones that have a significant amount of gold as well. It's the ETFs are the fourth largest holders after the U.S. government, Germany, and the International Monetary Fund. So pretty significant. His analogy, I guess, or the reason he brings this up is that there's no reason why this doesn't happen with Bitcoin too, and have innate buying demand for Bitcoin as we go forward. Now, could the SEC sit on this? Could they deny everybody? Possible. They've been delaying this forever and saying no forever. But if it does happen, watch Bitcoin go north again. So here's my take. I'm a bull on equities with my head on a swivel. And that just, because we have great themes that we're invested in. But I know that valuations are stretched. Bonds are going up. Bond yields are going up. And I'm not going to become complacent. I don't want you to become complacent. The short levels at 2,000 areas are a concern. That really surprised me this week. And I'm a bull on Bitcoin, period, mainly because I'm a bear on politicians. And I've covered that in the past, too. Okay, that's the show. Please also subscribe to my Bakes Takes YouTube channel. The audio is the same, but the charts that I reference are on the screen. Follow us on Twitter at BakesTakes_ and other social media. Please use your voice memo app. Tape your questions and email to bakes@bakestakespodcast.com, or write if you'd prefer. I'll keep you anonymous if you'd like. Thank you for listening. Mike Wilson is my producer. Thank you as always. Appreciate that. And have a great week. This is Bakes. And for much needed levity, this is Chris Porter. Hipsters ruin everything. And please click the link. It's about 4 minutes of laughs. And we need 4 minutes of laughs, in my opinion. So I will see you. Take care. Bye now.